Very good. Hope y'all are having a fantastic day. This is Randy Sadler with CIC Services, and welcome to our monthly training. In this session, we're going to discuss how to help your construction clients turn risk management insurance into a profit center. And of course, there's always something in it for you, those that work with us. I'd like to remind you to keep your computer or phone on mute unless you're asking a question. You can also go into the chat room. Normally I'll see that chat pop up, and then we'll have times when we pause and ask for questions. We do have a lot of ground to cover today, so I'm going to move fairly quickly, just so you know. And there may be some places where it feels like I skipped over some stuff. If you want the slides, we'll be glad to send them to you. And also, we'll be glad to schedule a call to talk with you about anything that you had an interest in. So let's dive in. I am Randy Sadler, your host today. I am principal at CIC Services. We are a captive insurance company manager. I tell everybody that my background in risk management started after I went to West Point and was a tank commander in the Army 5 years with soldiers and as many as 180 tracked and wheel vehicles. I was responsible for safety, for making sure we didn't have accidents. I learned a ton about risk management. Spent quite a few years in the corporate world, including companies like Procter & Gamble and Pfizer. I have been at CIC Services here 8 years. In the time I've been here, we've grown and just enjoyed helping businesses own their own insurance company. Here's our team. So we stand ready to serve you and look forward to it. We're in Knoxville, Tennessee, so it's a great location, and we have clients all the way from Florida to California to New York and all places in between in a wide range of industries. Tell you a little bit about CIC Services. We are a captive manager, which means we help businesses set up and own their own insurance company. And owning your own insurance company helps hold on to hard-earned wealth. It can help lower insurance cost. It can help insure your warranty program. It can do a lot of things, but we really specialize in the middle market. So this presentation will focus on small and middle market construction companies. So when I say we help businesses own their own insurance company, what does that do for them? Well, first, establish asset protected loss reserves. So having money that's moved out of one business into another that's protected. It's reserved for losses to pay claims in the event that their insurance company needs to protect their business. It increases profit or wealth for the business owners, often by millions of dollars over time. It can help lower or control the commercial insurance costs that they have. It can also, a captive can also insure uninsured or underinsured risks. I mean, we got a couple classic examples of that right now, like COVID-19, where businesses have property insurance that has business interruption, but since there's no property damage, many of them are not getting paid claims. Many of our clients at CIC Services have other forms of insurance that protect against business interruption, and many of them that have had COVID-19 impacts are having their claims paid. So that is a huge benefit of owning your own insurance company, is more broad coverage. And then there's also the benefits of insurance company tax treatment, which can be quite powerful. And we'll explain that some in our presentation today. So let's start with just a few things, and then I'll get into the meat of today's talk. You know, what is a captive insurance company? A captive insurance company is a real insurance company. The only difference really is that it has a limited license, and it's limited in that it can insure a business or related entities, or the business owner's business or related entities. So a business can't just go out and set up a captive insurance company and then write auto insurance for their neighbors. Their state will throw them in jail. The state has a consumer protection interest and is not going to let them do that. But you can, in fact, insure your own business. They've been around since the 50s. So the good news is they're not new. You're not moving into a new area that's untested, but they have been around a long time. And what do captive insurance companies do? They replace commercial insurance often. Some are part of it and help save money there. This is particularly powerful where a business has good loss control in place and they're paying insurance year after year after year, only to see none of it come back. And we even talked to some business owners that have had no losses for year after year after year, and their rates keep going up, which can be very frustrating. So commercial insurance replacement is a front and center, especially today in a hardening market. They can insure those enterprise risks, often uninsured or underinsured. They can insure warranties. They can insure bonds or issue bonds. They can also insure employee benefits or healthcare. And the beauty is, in small mid-market captives, this is particularly true, you can combine multiple benefits. In other words, warranties in the same captive as a commercial risk replacement, or healthcare in the same captive, or sometimes 3 or 4 of these coverages all in one captive. And the reason that makes sense is it spreads the fixed cost of the insurance company over multiple lines of insurance or benefits to the company. Very powerful move, and we have a lot of clients that do just that. So some of the benefits of captive ownership are a stronger business model, improved risk management, improved cost control, keeping insurance profits where they may have been getting paid away and never come back. Asset protection, because when a business owns or business owner owns their own insurance company, the money that moves into it's very difficult for creditors to attach to. We've even had some clients that their parent company went under and they were able to use their captive's assets to start over. Very, very powerful benefit. Accumulate assets inside that captive insurance company, and then receiving favorable tax treatment. So there's a lot of good benefits that your clients might benefit from, and they're very powerful in construction. And this is just a quick captive sample structure. You see that we've got business owner or owners. They own their construction company. It buys insurance from their captive. This is it in the simplest terms. Own the business, own the captive, and then reap the profits out of both. Now we're going to go into some more complex structures, especially when we think about construction, but that gives you a good start point, okay? And importantly, and this is true for many of the clients and firms that we work with, captives, if they're successful, they're going to build up wealth, right? So think about flow of funds from the business to the captive. It's providing insurance protection. If there's low or no losses, it creates assets under management. Many of our referral partners, in fact, like to manage assets, and they work with us because it ties their client to them tighter, deepens their loyalty, helps the client protect their business, and also creates AUM. All right, and so what happens to assets in a captive that aren't paid out in claims or expenses? Well, the owner keeps everything, and you'll notice a little icon I've got here. This is we're going to kind of go through the presentation today, and this will be a little bit like Where's Waldo? So this is where is the found money, okay? So we're going to talk about found money for your clients through our presentation today. Of course, there's found money for our advisors as well that we work with. So property and casualty insurance commissions through captive programs, found money for P&C brokers, sticky assets under management, as it's very difficult for clients to just rush out and buy a boat with money in their insurance company. So those assets tend to be more sticky. And then captive management fees. We often, when we're working with partners, we do share management fees with them. So there's 3 found money, Where's Waldo, and we'll come across some more as we go today. So as you think about construction, this is a little bit old, but this was a global risk survey. And you'll notice that this is back in 2015, and probably not a lot has changed. Which industries are planning to use captives in the next 3 years? Well, construction was number 2. And so you're in good company if you have construction clients, because they're probably growing, doing well. Certainly ours are. And when a business is doing well and growing, usually their insurance costs are going up. And so it's a good time to start thinking about how they can hold on more of that hard-earned money. This can be particularly important for construction because in a downturn, very often that revenue dries up. So the more they can stockpile in the good times, the better. So here's our agenda for today. We're going to talk about, a traditional fronted reinsured captive. That's really what your larger firms typically do. We do have some in that structure, but they tend to need to be pretty large. Then we're going to talk about our bundled captive program in construction risk and how that's helping construction owners lower their commercial insurance costs and keep more of their hard-earned money. We'll talk about enterprise risk in a captive, which can be a very powerful benefit. especially when there's so many things that can disrupt your business. Reinsurance for small captives. We'll talk about sub-default bonds and insurance. Now, subcontractor default bonds or subcontractor default insurance is a way to create a profit center out of thin air that didn't even exist before. That's very exciting one. Ensuring warranties through a captive. So many construction companies, home builders are putting warranties on their product, and the captive can back up those warranties. Very powerful way to use the captive insurance company. Then we'll get into taxation of captives, which is important, especially for small mid-market companies. And then finally putting it all together, and then a little time for Q&A. So let's start with traditional fronted reinsured captive insurance companies. Now, this is really largely what you'll find in your really large captive arrangements. Maybe somebody who's building large stadiums, et cetera. So we have the shareholder and they own the construction company. And so they have to have typically what's called rated or admitted insurance, partly because they usually have really large contracts, maybe required by, a huge state or municipality. And so they have to provide what's called rated or admitted insurance paper, often known as fronting or front. So they pay premiums to the front, get an insurance policy, and maybe that satisfies their contracts or their lenders. And then that front reinsures premium or transfers premiums and risks to the captive that they own. You notice the ownership dotted line here. And then the captive is going to reinsure part of its risk, usually catastrophic risk, over to a commercial reinsurer. And the front is normally not going to front this arrangement without having this commercial reinsurance in place, right? So the front is putting their name on it. They've been admitted by that state or municipality, and they are not going to take a chance on their name being dragged through the mud. So they're going to make sure that this captive is backstopped. And if there are low or no losses, then the captive piles up wealth, right? So found money. And so this is kind of a classic example. The business may buy $3 million of insurance. This could be across a wide range of construction risks, including work comp, auto liability, construction defect, builder's risk. And then that front's going to keep part of that money because they're providing their name. $2.75 million in this example passes through to the captive. $0.75 million to the reinsurer. In this example, could be more depending on how much reinsurance you buy. And then the found money's in the captive. So if the business is able to keep the claims low, the money left over in the captive is profits, right? So that's where the found money is in a large construction structure. And here's our example: $3 million in premiums paid, $250,000 fronting, $750 reinsurance, captive management, claims administration, and then maybe they have $1 million in claims that year that hit the captive, leaving $850,000 in underwriting profit in the captive. Again, found money. Well, a lot of the businesses that we work with aren't this large. They don't have $3 million in premiums. And so what we've done is work on creative solutions for small mid-market companies. And that's where we're going to spend our time. But I wanted to at least give you this backdrop so you have kind of a starting point. So let's talk first about what we call a bundled captive insurance company. Now remember, on this structure, we've got quite a few handoffs, right? So what if we can take a couple of those handoffs out and make it a little easier? Well, that's what we're going to do. So in our bundled program, your construction company client owns their construction company or companies. They may own more than one. So there's the ownership line. They're getting the profits out of it. They also own a captive insurance company, and there's that dotted line, and they get profits out of the captive. And so we minimize the handoffs by actually having an A+ rated commercial insurance company write the insurance policies to the construction company. The construction company pays premiums, transfers risk. And, oops, I went the wrong way. Sorry about that. Okay, there we go. But anyway, the commercial company has that A+ rating that we need for a contract, for a municipality, for a bank. And the commercial company is going to match their current limits, their terms, and their cost, right? But then that commercial company is actually going to reinsure premiums over to their captive. So in this structure, the client's captive is serving as a reinsurance company to an A+ rated insurance company. Now, this program can cover property, general liability, builder's risk, construction defect, and other types of coverage, but that can often rack up to quite a bit of money. So here's just an example of a business that's paying $700,000 for construction insurance for all the risks we outlined on the prior page. It's getting that A+ rating. They're getting the policy limits they need. So if they have a big loss, we know that this A+ rated carrier is going to step in and pay it, right? But we're sending $350,000 over to their captive insurance company. And if they don't have losses, or they have low losses, found money, can't beat it. And so let's just look at a really simple annual pro forma for this, premiums paid of $700. Sorry about that. To $350 reinsured, 100,000 claims paid by the captive, some captive management administration costs to run the insurance company, leaving $200,000 found money. Now, one thing we'll mention and cover more, the captive can make, in many cases, an 831B tax election. B tax is a small insurance company. So in addition to $200,000 in the captive, they might also have $84,000 of tax savings. So even more found money. Very good. So let's go to the next one, enterprise risk captive insurance company. So, and keep in mind, an insurance company can do more than one of these, right? So we're not limited. We've got lots of options. So, enterprise risk is really a discipline where an organization assesses every threat that it has and decides how to manage those. Some of those risks might be insured commercially. Some might be insured in a captive. Some they may just decide not to insure at all. Some may have a mitigation strategy to try to limit the impact. And then when we're doing enterprise risk management, we really want to think about our risks in three buckets, if you will. I mean, the first is core risk. And when you think about core risk, think about risks that you have to insure, usually because of some kind of obligation, right? The state makes you have auto liability insurance. They make you have work comp insurance. You don't get a choice. Your lender makes you have property insurance. So there's many times when we have insurance that we really don't have a choice but to have it. Now, operational risks, the middle bucket, are risks inside the business that theoretically the business owner and their team have control over, right? And strategic risks are risks outside the business that the business owner theoretically has no control over. COVID-19 is a blaring example of what strategic risk feels like, right? Many of you probably have clients that have been impacted, had their doors closed. And maybe you have a client in Minnesota that had their building burned down. So that would definitely be a strategic risk. So when you think about captives and insuring these enterprise risks, very often they are uninsured or underinsured. And I'm just going to spend a little bit of time here because these are real risks that really can affect a business, especially in construction. So administrative actions is a government agency coming in and causing a lot of cost for the business and potentially even fining the business. And you can actually insure against that. So example, administrative action would be OSHA audit that results in fines, right? Employment practices, some employee alleges that you discriminated against them or they were harassed on the job site. Litigation defense speaks for itself. Receivables, very often construction companies are in a chain of payers, right? So the large contract, they may go bankrupt and not pay downstream. So receivables is huge and it's worth insuring. Commercial crime often happens on job sites as well. Short-term disability, perhaps some key employees can be insured. Cyber speaks for itself. Reputation is very important and can be insured in a captive insurance company. The liability of any kind of product that what you construct or build could be insured as well. Let's step out, errors and emissions certainly, and then deductibles on commercial policies can be insured too. Let's step out, strategic risk, business interruption. We have a business interruption for natural perils policy. I have a construction client last year that had 85 days they couldn't work because of rain. It didn't rain every single day, but it just never dried out. They had a contract where they had to pay a penalty for every single day they were late. Their captive paid that. So that's a big deal if you're in the construction business. Losing a key account that you're working on, loss of a key customer, subcontractor default. A sub doesn't do their job and it costs you money. We have an example of this where a sub was working on their portion of a building project and used the wrong gauge of steel. So it was a little bit later when the inspector came out for the codes and said, this building's not going to stand when you finish it. They had to take the building back down and then build it back up with the right gauge of steel. Now, that doesn't sound like a big deal, but it was about $70,000 all in. And of course, the subcontractor basically ditched town, right? So they had to find a new sub to do the job. That does happen. It can be insured and a captive. A pandemic disease, no surprise here. Certainly legislative regulatory changes. So a government agency, regulatory body, legislative body can cause extra costs, stop a project. There's a wide range of things that they can do that can interrupt a business. Supply chain interruption, huge in construction as well. Having not being able to get supplies, certainly even more important if anything you're using in your building process comes from overseas and we get into a trade war, which we've kind of had off and on trade wars. So you can see just the need for thinking about uninsured, underinsured risks. So let's just do a quick pro forma on what that might look like. Let's just assume that our construction client insures these uninsured, underinsured risks, and we add them up and they pay $1 million of premiums. And we have a good year. Of course, we could have a bad year and spend millions of dollars in claims, but let's just say in a good year, their claims are $35,000. It costs them $65,000 to run their captive insurance company that year. We have $900,000 of underwriting profit and about $360,000 of tax savings. Again, there's our found money icon. So very, very powerful way to help your construction clients hold on to more of their hard-earned money. Let's quickly talk about reinsurance for small captives. Because when you think about this scenario here, we got to make sure, when we looked at the above examples, the reinsurance came from that A+ rated carrier or a reinsurer. When we think about enterprise risks that are uninsured or underinsured, we're still going to provide reinsurance, but we're going to do it a little differently. So we're going to do it via a reinsurance pool. And so here we have our construction company owner or owners. They're construction companies. They buy insurance from their they're buying insurance from their captive, and it's going to reinsure its risk with a pool of other captives. Now, in this case, our pool that we're showing as an example has 80 insurance companies in it, and they're all sharing risk, which is very powerful. One of the advantages of pooling versus reinsurance is that when you buy reinsurance from a reinsurance carrier, if you don't have any claims, they keep all the money. When you pool risk, whatever money doesn't go out in claims comes back to all the 80 owners pro rata. So pooling is a very hyper efficient way of sharing risk, almost like a co-op, if you will, that provides that powerful backstop that the business needs to protect their risk. But at the same time, it's so efficient, they get every nickel back that's not used in paying claims or running the pool. So this is just another visual way to think about it. The insured business, the captive, the owners, we're pooling, and we've got this visual of all these captives sharing. So how might a claim work in a pool? Well, let's just say your construction client has a loss that's not commercially insured, $200,000 loss. And let's say that what happened is one of their key salespeople quit and they lost a job that they thought they were going to get. And this was the profit they would have had on that job, right? So, well, that's actually probably, yeah. And so let's say that that loss of key employee cost them money, and then they had to pay money to hire somebody else to replace that key employee. So the construction company normally, and the owner, they just take the loss, right? What happens? Wealth is destroyed, employees get laid off. It's a big hit. However, if we have an insured loss, insured by the captive, that construction company has a loss that's actually insured, that loss gets addressed. So the construction company owner or owners file a claim. We send out a third-party administrator that verifies that the claim is legitimate, assesses that that was in fact covered by their insurance policies, that a dollar amount was in fact real, And the claim, once that claim is approved, the captive pays $200,000 to the construction company, which was much needed money at the time of the loss. The reinsurance pool, made up of 80 members, pays $102,000 to the captive. Again, there's found money, because when they had a loss, the pool offset or backstopped the impact. So you can see, very powerful way to help your construction clients insure their risks. All right, very good. So now let's talk about subcontractor default insurance, and then also bonding with a captive insurance company. So, bonding subs, very often construction companies have, many of them have a large army of subcontractors that work on their projects, and those subs may be buying bonds from a third-party commercial carrier, but very often that can be actually molded into a completely new profit center. So here we have a contractor, and they own their construction company, and the subcontractor is actually going to purchase their bond from the captive insurance company. Now, this also works with sub-default insurance. So we can either use bonds or insurance. Either way, if you think about it, the sub is now buying from the captive, protecting the contractor. So, think about doing that across multiple subs and turning that into a profit center. This is unbelievable found money. So this is an example from one of our clients. The numbers are pretty close. So the premiums they receive from all their subs to their captive is about $750,000 a year. Have some claims and captive management admin costs, but they're basically $500,000 of underwriting profit in the captive insurance company they own. They do qualify for the 831B election. So in addition to $500,000 underwriting profit, $200,000 tax savings. Again, there's our found money icon, where this construction client has been able to turn risk into wealth to create a profit center out of their risk management and insurance. I'll send you these slides because I don't want to spend a ton of time on this, but bonds can cover the sub and also the sub's employees. So sometimes a sub might default and the employees will actually sue the GC because they didn't get paid by the subcontractor. So the bonding would cover both of those, and that's really important. Bonds are normally regulated by state insurance agencies. So no surprises on any of this information here, but I'll be glad to cover it more if you want to jump on a call and discuss helping construction clients, or maybe you're working with a construction client that could turn bonding or subcontractor default insurance into a profit center. So yeah, some of the benefits of bonding with a captive are just that, profitability, create a new profit center. Better risk management, because the underwriting can be done more thoroughly by the GC and their captive. They're more motivated to prevent losses, obviously, because if your subs default, then it's coming out of your captive. So as a construction company owner, you have even more motivation to really manage those subs closely and keep a tight leash on them, resulting in a better business model for the GC. And then, of course, by having a captive, the potential to insure other risks that the GC might have, like we talked about already through like our bundle program, or by insuring enterprise risks. All right, let's talk about, we're almost done. You can see all these great opportunities for your clients piling up, and then we'll have some time for questions. So let's also talk about warranties. So in addition to bonding and all the other coverages we talked about, they can also issue warranties for construction defect. That can be patent defect or latent defect. But let's face it, things don't always go the way you want to. GC or a construction company builds a project, and sometimes things go wrong no matter how good you are, right? So in a common warranty structure, and this is not what we're going to recommend today for middle market companies, when you have a warranty, that's warranties issued out by a rated admitted front, if you will. But they often require a significant amount of money to participate, usually at least 250 that they keep. And then that may be reinsured, backed by the captive, owned by the owner, right? And then that's insuring the work that's been done. However, for a small or mid-sized contractor, the ideal way to do the warranty insurance is have the contractor issue the warranties. And most of them are doing that anyway. We have a client that installs artificial turf fields. So they are, in a sense, in the construction space. And anytime something goes wrong in their fields, they go fix it, right? They are out there either filling a hole, putting in new carpet, doing the work themselves, because they can't afford the hit to their reputation, right? So they have to back that warranty. Well, their clients want to know that that warranty is backed, and so they have a captive insurance company that issues insurance to them as a contractor, but then names the end user client as additional insureds because they bought from the contractor. So this is a very powerful way of satisfying the warranty needs of clients, and also providing asset protected loss reserves, and the tax benefits help accumulate those reserves. So in the event that down the road they have a construction defect, there's money to go address it. And in many cases in our structure, our reinsurance pool will also back the warranty insurance. So that's very powerful as well, because if you have a $200,000 mistake on this building, at least the pool's paying half of it. So really, really big help for the contractor when they need it. And here's an example warranty program. We've got $500,000 of premiums received, right? But basically covering those warranties. Let's just say that there's $200,000 in claims that year. That's an expensive year. 100,000 of those paid by the pool, right? So you don't have to pay that. You only have to pay 100 because the pool paid 100. And then we have captive management admin cost, 50,000, underwriting profit of 350. And then, I'm showing potential tax savings of 140. So we've got, again, found money. So I see a couple folks have hit our chat room, and I'm going to go there and see what we, well, it didn't pop up. Hang on. Let's see what we got. A couple questions here. Can they select which subs to cover, or are they required for all subs? Yes, they could select which subs to cover. Very good. Let me see here. A couple more questions in our chat room. That's it for now. Okay, good. Yes, good question. They can select the subs they want to cover for sure. Normally, keep in mind the sub is paying the insurance. So in a sense, it should be additional profit for the business, for the construction company, right? So if they were going to do a project and make $1 million on it, and the sub was going to, anything the sub pays to the captive, if the sub does their job, it's pretty much all extra profit. So it's usually an additional profit center. In many cases, you can't always make the sub buy from your captive. If you require that they carry the insurance, the sub, whether it be a bond or whether it be sub default insurance. However, since the GC has a really good sense for who the subs are, they could either, price a little lower than the commercial carrier, or, just encourage them to buy from their captive. But you can't make them do it necessarily. But obviously, it is a way to create a profit center, and you're essentially just balancing one sub against another, right? Okay. All right, let's keep going. So taxation of captives. I did mention that we'll cover that, and it is important. Insurance companies normally, and here I'm putting a traditional captive, which is normally a large captive, they're taxed very similar to, say, State Farm or Allstate. And, if you drive into any major city and you look at the 3 biggest buildings in the skyline, football stadiums, banks, insurance companies, right? Pretty straightforward in most cases. And there's a reason for that. Insurance companies receive premiums. They do calculations to reserve for future losses. So they don't have to pay taxes on that right away. They're able to invest that gigantic pot of money. And then when claims do occur, they pay those claims. And then eventually they're not able to justify the reserving, and they have to take it as profit. Well, that ability to invest a large pot of money not taxed yet creates significant wealth. Well, small and mid-sized companies have a powerful way to do something very similar. In 1986, Congress created the 831B tax election. This was part of the Tax Reform Act of 1986. At the time, we were going through a hard insurance market. Businesses had a hard time even getting insurance in many cases, and so Congress wanted to help small, mid-sized companies be able to protect themselves. And that's exactly what's happened. As captives have started serving small, mid-market companies, they're able to pool risk in pools and provide the kind of backstop that they need. But that 831B election says that as long as the captive insurance company receives now $2.3 million or less of premiums a year, then their tax rate is zero on their underwriting profits. Now keep in mind, when 831B was created back in 86, it was 1.2 million or less. It increased to 2.2 million in 2017. It's been adjusted for inflation ever since. Right now, it's 2.3 million. So if your insurance company as a business owner receives 2.3 million or less in premiums, then you are eligible to be taxed under 831B. And this creates the ability to really accumulate those reserves that we were talking about. So let's put it all together. Here's an example. So we've got a client. Let's just say that they pay premiums to a bundle carrier. I'm showing this in gray. Of $500,000. So they're insuring, let's say, their construction defect, builder's risk, property, equipment, right? General liability. Now, in this case, I'm showing 40%, $200,000 going to their bundle captive, right? For those large commercial insurance company risks, that's found money, right? 200,000 found money right there. Then let's say that they also insure some enterprise risks that we talked about, perhaps natural perils, business interruption, administrative actions. And let's say that they spend $500,000 on premiums to their captive. Then let's assume they have subcontractor default insurance of $200,000, right? That their subs are buying from them. That's more found money. And then let's say that they pay warranty premiums to their captive of $200,000 to backstop their jobs. They pay claims, they pay captive administration costs, $900,000 of underwriting profit in their insurance company, $360,000 of potential tax savings, again, found money. So you can see just found money, all through this example, a way for your construction clients to hold on to a lot more of their wealth. So give your clients a green light to turn risk management and insurance into a profit center. So with that, let me stop and see if we have any questions. You're welcome to put them in the chat room. You're also welcome to unmute and ask your questions. If you'd like a copy of the slides I covered today, just send me a note or Tom a note. Tom is one of my partners at CIC Services. We'll be glad to send you the slides and also happy to have a conversation with you.